Hello and welcome to our first MGO investment update of 2022. I am Paul Orchowski along with Michael Moskal and Scott Lipa, and we have a lot to talk about. So without further ado, we'll turn it over to Michael.
Well, thank you, Paul, and hello again, everybody. Today, of course, marks the end of the first quarter, and it's been quite an emotional roller coaster quarter for many investors. In the stock market, we saw the stock market hit new highs in early January, only to have a big 15% drop, sell-off in February and early March. And then the last couple of weeks, we've seen a huge rebound. Market's up about 11% in the past 2.5 weeks. The bond market, we've seen a lot of activity go on in the first quarter. We had the biggest rate moves in the bond market, interest rate moves in the bond market that we've seen in 30 years. And of course, in the commodity sector, the big commodity rally that started last year, and commodities meaning agriculture, oil, gas, metals, they all had huge increases, 20, 30, 40% gains in the first quarter. So today we're going to talk about 3 investment themes that we see as affecting your portfolios in 2022. 1 is inflation, 2 is interest rates, and 3 is globalization. First, let's take a look and see how the markets perform. This is actually through a couple days ago, the 29th of March. These numbers were all much more negative a month ago. So we have had quite an increase in the last month in the stock market. If you look at the stock market, the MSCI All Country Index, which includes all countries around the globe, that would be U.S. and foreign combined together, down 4.3%. Our markets, the Dow Jones Industrial Average and the S&P 500 have done better, down 2.8. Without the U.S., the index is down 5.8. And the reasons why, by the way, also is once Russia invaded Ukraine and that war started, European markets, Asian markets, which are much more affected by that war, they started dropping more than our market did. So the U.S. is still holding markets up this year. And I have MGO, our equity ETF portfolio on here. This is our flagship stock portfolio that has done much better than the stock indexes have this year, down 1.6%. We started overweighting in energy and consumer staples last year, which has really helped our portfolio hold up pretty well.
Yeah, Michael, I think it was the rotation that we did in our portfolios in the fourth quarter of last year, the rotation out of the shelter-in-place trade that sort of dominated the last 2 years since COVID started, and moved to more of and I know you're going to talk about it a little bit later, but a more inflationary friendly sectors of the stock market. And our timing appears to have been pretty good.
Yeah, so hopefully we can continue to keep that up. That's our goal for the year, of course. Bond market, again, we had some severe activity happen in the first quarter. These are some pretty negative numbers in the bond market that you just don't see very often. Again, going back 30 years ago is the last time we saw numbers like this. The U.S. aggregate bond index down 6.7% the first quarter. The U.S. government bonds down 9.5%. Again, I put our flagship bond portfolio in here, which is down 2.8%. So I think we've really held up well, and we'll talk a little bit about that in the future here. But the currency complement very heavy in TIPS, which are Treasury inflation protected securities, as well as floating rate bonds. We have some different type of bonds in there that actually do well when rates are going up. And other investments, barrel of oil. Everybody knows oil prices are up a lot this year, 41%, and that's on the back of last year's increase in oil. Gold's up 4.9%. If you just took an index at 60% equity, 40% bonds, sometimes investment people call that sort of an average investors index. It's down 5.3% this year for the first quarter. A couple comments, by the way, guys. I want you to kind of talk about this too a little bit. What we see as far as the future for the stock market this year, there's 2 camps, right, Scott? We just talked about this not too long ago here. One camp would say there's a lot of cash out there in investors' hands, which should do well for the stock market for the remainder of the year. You want to talk about that?
Yeah, I mean, what I find interesting in the insight that we have that most people probably aren't privy to is that our clients, I get a lot of calls when you have a first quarter like this, and just gauging market sentiment from who we have from our clients. The sentiment right now isn't should we reassess risk because the market's down a little bit. The sentiment is still a fear of missing out and looking at buying dips in the stock market versus reassessing risk. And I attribute it to, you don't print the money that the government has printed and the Federal Reserve has cut interest rates to zero. That all that money, in my mind, it has to find its way to the market or find its way to some investment, whether it be, the person getting the stimulus check may spend the stimulus check, but that the person they're giving the money to eventually finds its way to the market. And I really think that, a price correction here in the first quarter is going to be pretty temporary because there is so much cash on the sidelines still. There's still a lot of liquidity out there between individual investors and corporations, especially.
Yeah, so that's one camp. I think there's, people, some are in that camp.
Yeah.
And the other camp of people would say valuations are still very high. If you look at PE ratios and those kind of things, we have a war raging in Ukraine, which could get worse. And that's not going to do anything good for world economies. There's some people that talk about we've been on a 12-year bull market. Some point in time, we're going to have a bear market in stocks. So will be interesting to see what happens. I think for our portfolios, we're going to continue, like we said, to keep investing in areas like commodities and energy, consumer staples, because regardless of whether we're in a bear bull market, we think those companies are going to do better in that kind of environment. Wonder why we have inflation? Well, this chart measures money supply. So this is currency outstanding, cash, as well as what people have in bank accounts. And that huge spike up that you see there on the line graph, that was during COVID. That represents about $11 trillion of money that was printed. And a big chunk of it went into people's hands. Many people got checks in the mail, 3 of them. I think there was 3 tranches of checks that were sent out to try to help with the COVID situation. And, some people put some of that money in the stock market. Some people have it still sitting in cash, Scott, like you said. And then some of that money went to spend. Some people were out there spending money. And just go back to economics 101. When you put $11 trillion out there into the marketplace and the supply of goods is the same, or as we know, there's a supply issue now with things. So supply is actually down. But when you have more money chasing the same amount of goods, you're going to push prices up, right? That's just econ 101. So
that's $11 trillion of manufactured growth from when COVID initially hit. So we're 2 years into this now, but $11 trillion of manufactured growth when theoretically you and I and everybody else was staying at home and not spending as much money as they have in the past. So I only mention that because at some point you can't manufacture growth without paying for it in some way, shape, or form. And inflation is one of those ways we're going to pay for it. Right.
And this is something we didn't see. Because if you remember back when the Fed started printing money back in 08, 09, and Ben Bernanke was the chairman, and he talked about helicopter money, you just want to drop money out of the sky. And so the Fed started printing trillions of dollars. The Fed's money doesn't go to people directly, right? It goes into the asset markets.
Right.
So we didn't see inflation out into the marketplace where people are buying food and gasoline and clothing and those kind of things. We didn't see that the last 10 years. But now we're seeing it because there was $6 trillion came from the government that went right into people's bank accounts to spend. So, which leads us to our dilemma what the Fed has. The Fed's dilemma right now, do they try to stamp down inflation and go at it and risk recession? Or do they try to keep the economy growing and risk inflation going higher? So there's 2 risks there that they're going to have to make a choice on. They kind of have already a little bit. We know that because they raised rates this past month. And they also stopped money printing. Remember, the Fed was printing $1.4 trillion a year and buying bonds with it, mortgage bonds and government bonds. They're at 0 now. They're at 0 as far as new dollars are concerned. So they have cut back. It looks like they want to try to attack inflation, but that, of course, is going to risk recession. And so we'll see what they have to do here.
They want to attack inflation, but the truth with this kind of stuff is always in the middle. Like I'm reading stuff now that the Fed's going to raise rates 5 times this year, 6 times this year. I would be surprised if that actually happened. I think they'll take a middle ground of they'll use the Russia-Ukraine situation and other deterrents to the market to raise rates maybe 3 times this year, not the 5 or 6 people think. That's just my thought. I don't think they can raise rates nearly because of what you're saying. I don't think they can raise rates nearly as quickly as they're telegraphing because of that risk of recession. And that risk of recession isn't good for anyone politically.
Yeah, and that's the operative word, Paul, right? Political.
Right.
because we talked about, and I was sending memos out. We were sending company memos out too. It said the Fed doesn't really want to raise rates. They'd rather keep rates at zero because it just keeps the economy growing. Because if rates are at zero, people are going to borrow more money and spend money on stuff. It makes things look good. So for them to raise rates and risk recession is something they don't want to do necessarily. But there's something that's happened, as this chart says, that blue line's inflation. That we haven't seen inflation in a long, long time. And that's like the wild card. And so the question is, what's more politically damaging? Because they're going to get pressure from politicians. And when Jay Powell got renominated, remember, he got renominated in November to be Fed chair. And right after he got renominated to be Fed chair is when he started talking tough on inflation. So it just makes you wonder if there wasn't some kind of discussion that went on with the administration and saying no more talking about inflation not being transitory and temporary. You got to go at this thing. You got to attack this thing and get inflation down. Because my take would be, if I'm a politician, maybe the worst thing to me is come November and I'm up for re-election and inflation's at 8%, and my constituents, my voters, are saying, we're not going to vote for you. You didn't get inflation down. We're paying all this extra money for things. I can't afford it. So it's right. You're right, Scott. And Paul, the political pressure is going to be, we'll see where the political pressure comes from.
Well, they're going to try to walk that tightrope and right down the middle, and hopefully not make anybody happy and still keep or not unhappy, and then still keep the politicians, at bay to whatever extent they can. But it's going to be tough.
Just give everybody a stimulus check before the midterms. It'll be fine.
And you used a good word, by the way, the tightrope, because that's really what they're on right now. They're trying to walk this tightrope and trying to say, can we get inflation down without really harming economic growth? Because it's election year. It's like there's no good choices here necessarily. All right, globalization. We've really only been used to globalization, something called globalization, right? Which is really since the wall fell. In this chart, you see where it says third wave. That third wave is when the Berlin Wall fell in 1989. And that sparked, of course, this whole world peace kind of thing, this peace dividend that we called. And not that we didn't have things that were happening in the meantime, but they were small things. We didn't have big world powers that were at war with each other. So the last 30 years we've seen, again, just-in-time inventory was something that came from that, right? Where companies were saying, I can outsource, my inventory to, foreign and be able to get it within a week. China started making lots of our goods. We started farming out a lot of, in the US, we started farming out a lot of our production overseas. And it was good for consumers. Prices went down. So globalization tends to have the effect of, pushing inflation down, pushing interest rates down, pushing wages down, which is good for public corporations and may not be necessarily good for the workers, but it's good for the corporations. It has a tendency then to push asset prices up sharply. And so the question is, are we at the end of that cycle, and have we already entered into perhaps the beginning stages of deglobalization? Where now countries are sort of closing up their borders a little bit and starting to say, gee, we better start making things here at home and not be so dependent. And we know that the obvious thing right now, of course, is Russia and Ukraine, right? Oil. Mm-hmm. Europe is tremendously dependent on Russia for oil and gas. I think almost half their imports of gas come from oil, natural gas. So of course the talk is, how do we become not dependent on Russia or anybody else? How can we produce this domestically? But that has the effects just the opposite way of globalization. So deglobalization pushes interest rates up, pushes inflation up as costs go up. It has a tendency to slow asset prices down a bit. So we'll see what happens, but we're ready, and we're already investing sort of on the premise, I think, guys, right?
Right.
That we think this deglobalization has taken hold, and this is going to be a long cycle. It's not going to be a 2 or 3 year cycle. It's going to be 10, 15, 20 years worth of it, which is not bad, by the way. There's positives that come out of it also. It's not all negative. So we just got to be used to something. We got to get used to something a little bit different. How inflation, interest rates, and deglobalization are three themes. How do they affect your investments? As we've done in the past, inflation favors commodities, which we've overweighted again. We talked about energy, agriculture, metals. We still see that story. of that cycle of increasing prices in those areas going up, which will help those companies. Consumer staples, those are companies like Procter and Gamble, which you see the graph, the pictures on here are Procter and Gamble goods. These are companies and industries that can raise prices and people still have to pay it. So if I drive my car down to the gas station, I gotta fill it up with gas, whether gas is at $4 a gallon or $3 a gallon, I still gotta fill it up if I want to get around. Consumer staples, Procter and Gamble, gotta wash clothes in a washing machine, gotta buy Tide or whatever laundry detergent. Kids, families that have babies or buy diapers, where the prices are up 20%, they're still gonna buy it.
You know what I like, Michael, what I like about these sectors of the market, we've talked about it in the past, is with all that money that's been printed the last couple of years, we saw stock prices the last 2 years go up pretty exponentially. I think the S&P is up almost 77% since the start of COVID, or since it tanked right as shelter in place happened. I don't think you're going to get stock prices going up that dramatically over the next few years based on what's going on right now. And what I like about these sectors of the market, the energy sector, the consumer staples, those are all good dividend paying sectors of the market. Those are sectors of the market with dividend yields of 5, 6, 7%. And if we're of the mindset that maybe share prices don't go up on stocks as quickly as they have the past few years, focusing more on the dividend as a way to generate income makes sense. And these sectors do that.
Mm-hmm. Yeah, because the question, I think, and we've all had these questions, in the recent past from clients, as far as what do higher interest rates mean for stocks, and what does it mean for us? And you can't almost answer it on a global basis because it's good and bad, right? Because there's certain sectors that do well, like we just talked about, Scott.
Yep.
Those sectors will do well when rates are going higher, especially if inflation's higher. And there's other sectors like technology, that tend to not do as well when you have rates that are going higher because they're not paying dividends, traditionally. The big tech companies do, but a lot of the tech sector in general is usually a low interest and low dividend paying sector. So just consumer discretionary is another sector that we've shied away from more recently. That would be areas where you're making more long-term goods like washing machines or dishwashers or refrigerators. People can defer, unless it breaks, people can defer those purchases. There's discretionary. They don't have to buy it.
Mm.
So those are the kind of areas that we've been shying away from, which has been good because those technology and consumer discretionary are the two areas that have done the worst this year. Those are sectors, like you said in the fall, that we were reducing those sectors and getting to the other sectors. The other question I know that you guys have with clients too, should I get out of bonds because rates are going higher? That's a very common question, right now.
Yep.
Especially, when quarterly statements come out and people are going to see negatives with their bond holdings. And, most people, I think, understand that you're going to have ups and downs in the bond market, but, this has been a kind of a severe quarter like we talked about. So what would you guys say to that? What's your answer to that question?
There's a couple of things to that, right? You still need diversification. You still need that conservative part of your portfolio because we don't know what's going to happen in the future. So I think it will frustrate people to see negative signs in front of bonds because it's been so long since that's phenomenon has happened. I don't know. I do get that question. The question I have, or what I think about that is, if that is the case, and it will be the case, people will look at their returns and see negative signs in front of bonds. I'm wondering if that doesn't push more money toward the markets as people say, well, this is supposed to be the conservative piece of my portfolio. It's not necessarily doing what I anticipated it would do. Maybe we need to take that bond money and move it more towards stock. And I'm guessing that's a conversation or a theme that develops throughout the rest of this year, at least with people that I'm dealing with. I'm guessing I'm going to get that question a lot. And I wonder if that does push more money toward the markets as people get frustrated with that conservative piece of their portfolio.
Yeah, I think that's happening. And one of the things I talk to clients about too is just, you can do other approaches like a laddered bond approach or something that you can kind of just go with the increases in interest rates. And as long as you hold things to maturity, you're going to be fine. What you're going to get. You're going to see short-term drops when interest rates spike up, but you could still get the benefit of bonds by doing it that way.
Yeah, and you're both really, those are great answers, guys, by the way, because that there's to move. So there has to be a re-rating of risk then, Scott, right? If clients, if someone wants to move money out of bonds into stocks, then they really got to understand they're moving from a lower risk asset to a higher risk asset over time, even though it may not seem like it right now because bonds have a more negative return than stocks do right at this point in time. But you're both right. There's ways to, I look at it as it's still part of diversification. It still operates and offers a lower correlated asset to stocks. So when stocks are, it's the zigzag thing, right? When the stocks are zigging, the bonds are zagging. They're doing something different, which again just reduces overall risk in portfolios. There's another thing to keep in mind too when it comes to bonds and when rates are going up. When we're investing in shorter term maturities with our bonds anyway, in what we have with our portfolios, they're reinvesting cash and matured assets at higher rates, right? Higher yields. We haven't seen that in a long time. So we kind of forget about it because it just hasn't happened in a long time. But as rates go up, that just means they're going to be reinvesting at higher rates, higher yields in the portfolio itself. So I go back to, because I want to go back and look at, and you guys remember our handy Chase Investment Performance Digest? This was our resource before the internet. All right, but if you look in there, 1975 to 1979 was a period where we had rising interest rates, rising inflation. And I mean really rising interest rates and rising inflation. Inflation went well into double digits. Interest rates went up to 20% at one time in the early 80s. So you would think, oh my gosh, the bond market must have done really horrible during that time period. Well, from 1975 to 79, government and corporate bonds were up 6.7% a year annualized during that time period. So again, it's because they are reinvesting along the way. Now, it doesn't mean quarter by quarter. There wasn't some quarters where they were down. Okay, but if you look at that time period, that 5-year time period, it actually averaged 6.7% a year in return. So I think if you stretch out the time horizon a little bit with bonds and say, let's look at it from a little longer perspective and not just one quarter or even 1 year, we're not going to have rates rising like this, doubling every quarter. Okay, interest rates are not going to double every quarter. We just had a very severe situation happen where rates did double, in this first quarter, which is a very unusual situation. So it's good in the fact that they can reinvest at higher rates, higher yields, and I think it still offers diversification. And Paul, there are ways, like you said, ways around it to mitigate some of the ups and downs of bonds.
And Michael, so rates doubling in the first quarter, interest rates doubling in the first quarter. Do you think we're seeing a peak? Like, is the 10-year Treasury peaking right now for 2022? I kind of feel like it is. I kind of feel like it's gotta pull back from where it is, just based on how dramatic the move was in a 90-day period.
Paul?
Yeah, I don't know. I think it's got room to go up a little more yet. If the Fed keeps raising rates, you could see it. I'm kind of thinking it may be close to 3 by the end of the year, but we'll see.
Yeah, Scott, I think what we'll see is we're not going to see that kind of severe increase in such a short period of time. So if we do drift higher, I think it's going to be drifting higher and not just spiking up parabolically, not just going up in a straight line like we had the first quarter. So we probably are oversold in bonds, meaning the prices, because when yields go up, of course, prices go down. So we're probably oversold in bond prices a bit because we've had a very severe increase in yields. So, but I'm probably with Paul that I think we'll drift a little bit. We may see a decline in yields a little bit, and maybe it goes up a little bit and it continues to drift a little higher. But when it does that, it gives the ETFs, the bond funds, a chance to reinvest in higher yields. And so the impact is not as severe on the negative side of things. By the way, just one comment. This is a 5,000-year-old chart. It's not a 5,000-year-old chart. It goes back 5,000 years of interest rates, which we were talking about before. And I guess they do have records going back that long where, with credit and what money was being loaned out at and what credit rates were at that time, going back that long.
3,000 is that 3,000 BC?
Yeah. Pass down.
I don't know
Rates
how.
were-
I don't know if I trust the data.
Rates were at 20% back in 3000 BC.
I don't trust the data.
The point is, of course, of this chart is that we're at rock bottom rates that we just haven't seen in a long time. And the odds are very high over the next 10, 15 years, the cycle, 20 years, whatever the cycle is, that we're going to see rates up, headed the other way over time. All right, deglobalization, how does it affect investments? Commodities again, agriculture, energy, we've been talking a lot about that. It's very favorable to those areas. Companies with pricing power, we talked about Procter and Gamble's of the world. Small and mid-cap stocks, why? Because large cap stocks, big companies, if you look at the S&P 500, I think 50% of those companies, their revenue is generated from overseas. So if we do have deglobalization take place where you see companies starting to kind of take things into their own border, into their own countries, small and mid-cap companies, small and mid-sized companies are more domestically oriented. They're selling their products to more of the domestic and not foreign. And then artificial intelligence, AI, innovation, metaverse, application. These are two plays that we would say we're looking at to invest in those areas based on deglobalization making wages go up. So if globalization, if countries working together helped us to be able to outsource wages to cheaper places and be able to get, cheaper wages, then just the opposite with deglobalization. If we're going to move things in-house here into the US, that's going to mean higher wage growth, which means companies are going to be looking at ways to try and keep wages under control, which could be robots, other artificial intelligence, and doing things through the metaverse. So that's our themes. So at least at this point, and we'll see how things play out. We'll come back on and talk a little bit in the next quarter. Anything you guys have for last comments?
I don't think we answered the one question everybody asks us. Where's the Dow? Where's the market going to end the year? How much are we going to be up or down by the end of the year?
Okay, Scott, you tell us.
All right. I would say the S&P will be up middle single digits, maybe 5 to 6% for the year.
Yeah, I've been telling people I think when the end of the year rolls around, we'll be up somewhere between 5 and 10%, kind of like we were predicting it before the beginning of the year.
Yeah, I think because we all were around the same spot. I would say 8%. So we will. Then that's a nice growth from here because it's negative, right? So we would have to have a 10% gain for the rest of the year. So, but so we'll see. We'll see where it goes. All right. Well, thanks everybody for listening and watching. If you're watching, and we'll see you next quarter.